2024 is almost over with. Gosh, where'd the time go actually? But it's not too late to tax plan and decrease your taxes for 2024. If you are a freelancer or small business owner who files a Schedule C, I made this just for you. Hello, my name is Sonia Narvaez, and today I'm going to guide you through a clear step-by-step plan to ensure to get the maximum tax savings before it's too late. So let's get started. Number one, maximize business expense deductions. Well, you need to first figure out where you are financially for tax preparation purposes. So you need to know, once you have your income and expenses, have you made money? Have you lost money? Once you have assessed that you've made money and your tax liability will be a certain amount, let's now consider buying things in the business that we can use to deduct it for this year. So let's say you have a job coming up in January. So now you want to buy those supplies in this year so we can deduct them this year. And you can do that with anything, with any kind of business that you have. Do make sure if you're buying equipment or certain complex things that you consult with a tax professional, because not everything can be deducted at once. So just keep in mind, we can use expenses coming up this year so we can lower your tax liability. And it is very important to remember that you're assessing where you're at financially before you make these purchases or you make these decisions. Step number two, leverage the home office deduction. And I see a lot of this. People don't even realize that they have not taken advantage of the home office deduction. Do you work out of your home? If you do, if you use any portion of it for business, and it must be exclusively for business, you are entitled to take that deduction. So the IRS is going to let you deduct a portion of your rent, mortgage, utilities, internet costs, and many other things that you may be spending in your house. And this is going to apply to whether it's a little small cozy corner that you used to work out of, and or a whole room that you may have and you may be using in your home. This is something that a lot of people miss. And what happens is they did not include it in their expenses during the year because these were personal expenses. But at the end of the year, it is important to remember these, take a portion of them and add them to all your other expenses that you have in your business. Many people forget to do this. So remember to do this, and let's lower your tax liability by doing little things like this. Step number three, contribute to a health savings account. As a freelancer or small business owner, contributing to a health savings account or HSA is a very smart strategic move to reduce your taxable income. Now, this is going to help you save for future medical bills, prescriptions, doctor visits. Now, in order to be able to qualify to have an HSA, you must have a high deductible plan. And my gosh, most health insurance today have a high deductible plan. If you're single, you qualify, you have a $1,600 deductible. And if you have a family, you have a $3,200 deductible, which is very common nowadays, which is the reason why we have this. Now, very simple, be sure to go to your bank and open an HSA account. Most banks will be able to do this for you. Just go to the bank and open the HSA account. It's not that complicated. By contributing to the HSA before the end of the year, you are going to lower your tax liability, but you're also setting aside for medical bills. It's like a little savings account, pre-tax, so you can set it aside for future medical bills. For families, sometimes the braces, their children all of a sudden have a $4,000 bill for braces, but yet the HSA has been growing and it became so handy to be able to use it when those braces need to be put on. Number four, retire in style. Now, remember to keep track of what your income is, what it's going to be, what your taxes are going to be like, and contributing to a retirement plan like a SEP IRA, a solo 401k can provide significant tax benefits. These contributions obviously are tax deductible and will lower your taxable income. Now, remember, you can contribute to a regular IRA until April 15 of 2025 for the 2024 year. Now, this move is strategic, and what you want to do is you want to figure out whether yourself or a preparer, you want to make sure you say, okay, so how about if I contribute X number of dollars to the IRA? How much is it going to save me in taxes? And when they calculate that, at that point, you figure out whether it's really worth it for you to do it. But it usually does help. If you wait until April 15, figure out what's the most benefit for you at the time, because at that point, you're basically ready to pay for income tax if you don't do this or lower your taxes. You could always benefit long term from keeping the money in your pocket and not paying it to the IRS. Step number 5, deferring your income when needed. Now, in business, timing is everything. If you've had a great year and expect to be maybe in a lower tax bracket the next year, deferring your income can be a smart strategy. Now, if you delay your income until next year, even if it's just until January, you're going to lower this year's taxable income. Now, this could potentially drop you into the lower tax bracket for this year, and you are going to save some nice income tax money. Now, this is about delaying payments that you're going to receive. This is not only going to help you manage your cash flow, but minimizing the taxes, and obviously you're going to get the cash in January. Now, after you have reviewed your financial records and apply these tax saving strategies, if you feel like you still owe money to the IRS, talk to your clients about early invoice flexibility. So basically ask them, is there any way they could be paying you into January rather than December? Now, you do have to realize that they may be looking to have and apply the same strategies. So stay flexible, and whatever you can get paid next year would be best, especially if you've had a really, really nice year. Number 6, plan for estimated tax payments. Well, and that's what we're trying to avoid with all these steps. So after you review all your financial records and remember, go back through each one of these steps. Try to see if you can apply them. If you still feel that you owe money, consider making an estimated tax payment by January 15. Now, you don't have to make it. You'll have to go back and look at your records from the previous year to find out if you have to or not have to make a payment by then. It is recommended that you do it then. Now, by making this estimated tax payment, this can help you avoid any unnecessary penalties and interest. So it is important, with proper planning, you can ensure that you're not caught off guard in this coming tax season. By following these steps, you will be prepared for tax season, and potentially, I am sure you will lower your tax liability. If you have any questions about how to take advantage of the latest tax savings, book your free complimentary consultation with a member of my team. Simply click in the scheduling link in the description below and pick the time that works best for you. We would love to help and meet with you.